Hello, everyone. Welcome to another Tip Tuesday. Glad to have you guys with us. Geoffrey Nance here. And today we're going to be talking about a topic that may be familiar to some of you, but you may not know, as Paul Harvey said, the rest of the story. At Tradeway, we talk a lot about the benefit and value of trading, of short term trading, of what some call swing trading, which is the understanding that stocks move up and they come back down, and they move up and come back down. And they form these patterns, and we can use these patterns to determine when we should buy and when we should sell, trying to get aligned with the overall market tone and what it's doing. Well, today we're going to be talking about buy and hold. And it's a little different. It's actually what most people will do. So if you really don't have much experience or education with trading, you're probably a buy and holder. So we're going to talk a little bit about what that means. And then we're going to look historically at why that's not necessarily a good thing, why people tend to do it, and how it can actually still make you money when done the right way. So we're going to talk about buying and holding. That's going to be the main uh, key point of emphasis for today. So I think it's important first that we just kind of define a little vocabulary here. So what does it mean to buy and hold? So if that's what most people do when it comes to their investment history or their investment activity, what does that really look like? Well, it's really pretty simple. We're not really trying to confuse you here with terminology. Literally, they're going to go buy a stock and then they're just going to hold that stock for a while. I mean, it could be years, it could be decades. And in fact, that they may have no real plan to actually ever sell it. Now, some of you might be sitting out there wondering, going, well, what's really the point of that? Like, why would you buy something and then just hold it if you never really have a plan to sell it? Don't you only make money when you sell it? Well, that's a good point. In fact, that is the reason that most people do buy and hold, is that they have no real idea of when they should sell. But they're very, very concerned about selling too early. So what they would rather do is take an expense rather than, sell this thing even after it had maybe, moved up 75, 80, 90% in value, because they're going to be looking at it going, oh, if it would have doubled it, I would have sold it, or they have some kind of number in their mind, and they say, well, but if it hits this point, then I'll sell. The problem with most people when it comes to buying and holding is they don't really have a sell point in mind. They're just going to buy this thing, and then they're just going to be like, here we go. And so you may even see them, they may watch their account, they may get their statement from their broker, and they're like, oh, I'm up, X amount of money this month. Oh, I'm up X amount of money this month. Oh, I'm up X amount of money this month. And then they're like, oh no, it dropped. But they don't have a plan to sell. And in fact, they don't really have a plan at all. Now, what's interesting about this approach to essentially investing, it's not really trading, it's more just like an investment. It's basically akin to buying a painting. So you go buy a painting and it increases in value. Great. Now, what do you do with it? I mean, you hang it in your house, you look at it, you go, hey, isn't that cool? Hey, it's worth a lot more than it was when I bought it. And somebody's like, oh, it's cool. Yeah, I like it. It's nice. Then what do we have at that point? It's like, okay, so what is your plan? Now you're sitting out here and now you have to decide, all right, so what am I going to do now with this stock? Do I have a plan to sell it? Because the only time I'm going to make money is when I actually do sell this thing. So the reason that most people simply just buy and hold is that they have no real plan of when they should sell. So obviously they don't know that there's a chart. They don't know what historic highs have been. They might look up some of that stuff on computers, but what happens when you get to a new all-time high? How do you deal with that? And then they often have trouble with something like a true bear market. In fact, we're going to look at that here in a few minutes here and just kind of show you what would be the danger of buying and holding. Well, the danger to buying and holding is when you get an elongated bear market and your stock follows along with it, then you could lose a high percentage of your value. And it may take years, at least historically, It may take years for it to come back to the same price point. Now, in the market that we're in currently here, about to finish up 2021, it's much faster. It's much faster. Our bear markets, they don't last 6 to 9 months, or certainly not even years. There have been bear markets that have lasted for a year and a half. We're going to look at some of those in just a second. But our bear markets recently, over the last 5-10 years, at max have lasted a few months, and then they've been over, and the recovery has been very, very quick as well. So some of this has to do with just the market and the way that people are trading, the amount of access that people have to trading, and just the amount of money in the market at this given time. And then some of the computers certainly have a part in that, and just seeing some of this high frequency trading going on has certainly impacted the moves of the market overall, and certainly of these individual stocks on a shorter and shorter time frame. So let's answer this question. Can I make money buying and holding? Absolutely. Yes, you can. Now, if you've attended one of our events, you might be like, whoa, Geoffrey, I thought you guys were against it. We're not against it, right? We want you to make money, and people that buy stocks and hold them, and when the market goes up, they can do well. They can do quite well. But you have to be willing to sell, because see, if you had a stock that went from $5 to $100, you might be thinking, well, I'm up $95 a share. If I had 1,000 shares, I'd be up $95,000. Well, have you made $95,000? No. Well, you say, well, my statement says that I'm up 95. It's okay. That's what they call unrealized gain. Why is it unrealized? Because it's not in your account. You don't actually physically have that money in your account. Why? Because you haven't sold. So it may be worth $100, but if that stock drops down to $5 and you bought it at $5, guess what? You might have held that stock for 5 years and you've made $0. Okay? Because you only make money when you sell. Now you say, Geoffrey, I bought it at 5 and it went up to 100, but I sold it at 50. Okay. There's a little regret there, right? That you sold it at 50 instead of 100, but at least you made $45 a share. Again, going back to our painting analogy, you have this painting, it's worth, $1 million, but you didn't sell it. Well, now you can't sell it for maybe $500,000. You say, well, it wasn't, I bought it for 1,000. So it's still amazing to me. I'm good to go. But you're not going to make any money on it. If you end up dying and you still own that stock, then you're just going to pass it on to somebody else. Nobody's going to make money on that thing until it's actually sold. So the actual profit is the difference between where you bought and where you sold. Well, for most people, particularly if they don't really have a plan, or they don't understand charting or how it works, then they don't have a plan of where they're going to sell, unless they just kind of throw out a random number and say, well, when my stock gets here, I will sell. So certainly you can do that, but what we would advocate is, how about you get the education so that you understand where your stock is likely to go in a shorter time frame, and then you can make a decision on when you should buy and sell. And certainly at least be at a place where you could recognize when the market is going to make a major pivot. So if we are going to turn into see a move where the market does end up dropping 20%, those ones we're going to look at here, we're going to go back to like 2001 to 2008. And what you'll see is the market actually gets cut in half, essentially twice. Now, we haven't experienced anything like that. The furthest we've been down over the last 5 to 10 years is about 30%. But what if there is a big bubble forming out there? And what if the S&P does fall from about 4,700 all the way down to 2,300? Would you as an individual be prepared for that? Would you continue to hold your stock despite the S&P falling that far? Or would you be at a place where you're like, look, I don't know how far it's going to fall, but I want to at least get some profit out of this before, it gets down to who knows what. So I'm going to switch over. I'm going to show you guys what this looks like, so that you kind of get a sense of maybe some of the downside to buying and holding, as at some point you do have to sell if you are going to make a profit. And that's what we're gonna see here with this screen I'm going to share here. All right, so you should see this, and what we're looking at, let me go back over here to the S&P real quick. And basically the S&P 500 is just a good idea of what 500 of the strongest stocks are doing, and it makes up the S&P 500. We kind of use that to get a sense of what the overall market is doing. And what I want you guys to see is that we have two bear markets in this picture. I'm on a weekly view, so each of these candlesticks represents a week. But I just want you to see for about a decade here from 2000 to, essentially 2009. Now, the new bull market starts over here in 2009, and we may carry that forward in a second just so you can see something. But guys, listen, if you got into the market and let's just say you got in 98, 99, and this thing moved up, it got to around 1500. But notice we had this really long, like almost, year and a half, really two and a half year bear market. Now that's a super long, bear market. That's our tech bubble there. But yeah, you can see here the S&P drops from 1500. It gets cut in half, 750. So basically, a lot of these stocks lost half or more than half of their value, or close to half of their value. So if you had been in a similar type of trade, now you might have been in this thing for, let's say, 2, 3, 4, 5, 6 years, and you're down. Maybe you've lost half of the money you had in that trade. You say, well, Geoffrey, what if I just ride it out? 7, 8, 9, 10. Hey, here we go. 11 years. Now, what's interesting about this is we've now been in this trade for 11 years, and essentially we're right back here we were about 7 years earlier. So from 2000 here to 2007. That's how long it takes. Once this bear market started, where the market got cut in half, it took another 4 years for it to just simply get back to 1500. And as you'll notice, as I play this forward a little bit, similar thing is going to happen over here in about 2012. So the S&P is going to go all the way back up from down around 750, below 750, but it's not going to get to 1500 until way over here in 2012. It's not until about 2013 that we break out of that. So guys, think about this. 2000, 2007, 2012. Those are the 3 times that the S&P hit 1500. 3 times over a basically 12-year stretch. That essentially means that you had one bear market in 2000, 2001. You had another bear market here in 2008. And in that stretch, 2000 essentially 2 to 7, or I think it's 3 to 7. So 2003 to 2007, you had a bull market run where the S&P doubled. There's once. You had a bull market here in 2009 to 2012, almost 13, where the S&P doubled. So the S&P doubled twice. But if you happen to buy up at the top of 2000, you may not have made a single penny on your stock after holding it for over 13 years. See, if you bought it right here, you would have now been in this stock for over 13 years. Now, once we get past 2013, it doesn't get below 1500 again. So obviously now we're up 3 times that. So it's just, we've had bear markets, but none of them have been sustained, losing half the value kind of bear markets. We haven't seen any of these, year long, year and a half long, 2.5 year long bear markets for sure. So that the buy and holders have benefited more based on the recent type market rather than something that you would have seen maybe historically once you had a longer bear market where it did last, for a year and a half or so, and the market did get cut in half. You say, Geoffrey, what does this look like for a regular stock? Well, guys, let's check out Amazon. Notice that if you'd bought Amazon, you had heard about this company, you said, man, I feel like it's really hot. And tech is really, really hot. And you decided, I'm going to go jump into Amazon at $100 a share. And then right when you got in, the bear market came. The bear market crashed. The .com crash came. And you bought Amazon at 100. And then for the next year, you watched Amazon drop even below $25. Guys, Amazon in 2001, this might blow some of your minds, was an $8 stock. Over here at its lowest, it was like a $6 stock. Amazon was a $6 stock. Think about that. Now, when it comes to the upside of buy and hold, we'll talk about that here in a second if we bought Amazon at $6. But in our scenario, we bought Amazon at 100. So when are we going to break even? When are we going to get back to where we bought it? Not 2000, Not 2001, not 2002, not 3, not 4, not 5, not 6, not 7. There we go. Yes, 7 years later, we can get out for nothing, no profit whatsoever. Well, that's kind of not ideal. All right. When do we get past it? Finally, 2009. So 9 years later, we finally break out. We're in this new bull market, and now Amazon is going to take off, right? And so from 100 on, we would be fine. But the question is, when would you sell it? So it took you 9 years to even really be profitable. Now, when are you going to sell it? You're going to sell it at 200, make $100 a share. Now, again, you would have been in this thing for over a decade. But if you doubled your money, I think everybody would look at that and say, hey, doubling my money, that's a good sign. I'm kind of glad I did that. But 10 years, if it took you 10 years to double your money, is that the most effective way that you could trade? It's okay. Now let's zoom out here and we'll see where Amazon is today. So what if I was a true buy and holder that really had no plans to sell? What would this look like? Well, Amazon is up to almost $4,000. And if we bought it at $100 a share, we'd be up an amazing $3,500 a share. That's crazy, right? If we bought it at like $5, $6. Remember when it was at $6? Now you would have held it for about a decade, 2 decades now, I guess, and it'd be up incredibly. So can you make money buying and holding? Well, absolutely. Absolutely you can. But at some point you have to sell. So let me ask you guys this. If you'd have sold at 200, how would you feel about knowing that that stock that you were going to buy and hold was at 4,000 today? Yeah. All right. Or what if you sold at 400 and now you know it's at 3,500? Or what if you sold at 1,000? See, because those are the kinds of questions that the buy and holder constantly ask themselves, and then they assume, most of the time rightly so, that the stock will go up over time. Most of them do. But guys, listen, there are some stocks that were worth a lot more than they are today, and they just continue to fall and fall and fall. And some of those $100 stocks are now $5. So you can continue to hold that, see if it gets to 10, see if it gets to 15, 20, 30, maybe again. But some of those stocks may never see some of those higher prices when people initially purchase those. That's the danger of buying and holding, is that stocks don't always recover. The company has to continue to grow. That stock has to continue to climb as a result of that growth. And if that doesn't happen, then just simply because you're holding doesn't mean you're going to make money. And eventually, you're going to have to sell. So hopefully you guys enjoyed that lesson on buying and holding. A little trip back down memory lane there, just to give you a chance to see what does the market really look like, what is really buying and holding, and what are the alternatives to that. And obviously the alternatives to that are looking at shorter term trading within a range, understanding stocks movement within a range, and then being able to buy and sell. What's the benefit of that? Well, if you buy and sell, you don't have to stay in through those down moves. You can buy it low, sell it high, get out before it drops. You can see it drop. You can get back in at a low point, buy it again. And that's what we advocate here at Tradeway. If you want to learn more about that, there's so many ways to do that. You can go check out tradeway.com, but we have plenty of opportunities for you to learn more about trading and what that looks like. But if you're a buy and holder, look, just have a plan. We have a plan. You're going to sell at some point. It's highly unlikely that it's going to be the highest point ever that stock is going to go. Be satisfied with your gains. But remember, just because you're buying it doesn't mean it's always going up. It can drop, and sometimes it just keeps dropping. And we don't want you to get stuck in that. Guys, thanks for being a part of Tip Tuesday. We will see you next time. Have a great Thanksgiving.